Good evening and thanks so much for tuning in once again. Now, I mentioned that the first conversation today will be about the basics. And the basics relate to financial planning and the setting of goals. My guest today is Amol Joshi, the founder of PlanRupee Investment Services. Thank you so much, Amol, for joining in. You know, I've spoken to quite a few experts about the setting of goals, and one of them has said that investing without setting goals is like driving a car without a destination in mind. It may be fun, but chances are that you won't get to where you need to be. Would you say that the setting of goals is the most important thing that you could potentially do?
Alex, hi, good evening. As always, a pleasure to be on the show. Thank you. The other expert that you spoke of, he could not be more right. I completely echo the sentiments. See, it's simple. Either you give it a technical name or a financial jargon like goal setting, financial planning, or investments related some other jargon. But suffice to say that each one of us essentially plans for our financial goals knowingly or unknowingly. Now, what do I mean by that? Even if you have to pay your child's tuition fee, suppose 60,000 rupees 6 months later, there is a thought that runs in your mind as to how I'm going to get those 60,000 rupees out of my monthly investment, monthly income, monthly expenses, and I'm going to make a provision to accumulate that amount. It could be your annual holiday, which costs, let's say, 75,000 rupees or 1 lakh rupees. You're always planning it without really knowing it. Now, the next logical question is, if you're always planning it without really knowing it, why not do an actual financial planning or goal setting, whatever you may call it? Why not do a goal setting so that you will have the roadmap very, very clear to you? And after taking the examples which were mostly near term, like tuition fees for the each financial year or annual holidays, why not take something as important as retirement, something as important as higher education of your child that may be 10, 15 years away, or a retirement 20 years away? If you plan for it today, the chances are you will not get negative surprises at the end of the journey.
Okay, now Amol, before we get any further into how you should go about setting these goals and how you can subdivide them into possibly the duration, let's talk about what happens when you don't set these goals. Because I think a lot of new entrants to the financial markets, a lot of new people who are discovering the stock markets for the first time tend to get carried away with the returns that they might get in a very short period of time and are not really interested, shall we say, at this point in identifying why they are doing what they're doing. What are the pitfalls associated with not setting financial goals?
Alex, there are so many of them, but especially since you touch the equity markets and returns and getting returns in a short period of time. Now, these are phases of the market. Market does not give you a straight line 12 to 15% return. As well as, goes without saying that it will obviously not deliver 100% plus kind of returns that it has delivered in last 1 year. If we were speaking 1 year back, then market probably was not doing as well and it was not nowhere close to the all-time highs. So these are the phases. Now, at each phase, if you go by what the near-term return has been, you are not going to get a very good investment experience. Now, what do I mean by that? If you take example of Sensex, it was in the vicinity of 40 or 42,000 rupees. Let's say in Jan-Feb 2020. And then we saw COVID-related, lockdown-related global crash in the last week of March 2020, where your Sensex of 40,000, it was in the vicinity of 20,000 or so, 40,000 loss. I mean to say 40% crash in the market. Now, if you are somebody who goes by the near-term market returns, you will be completely out. You would not allocate any fresh money in equity simply because you will see last 1 year return is 40% lower, 40% negative. Now cut to today. Now you are today able to see last 1 year return is 100%, 110%. Now the important point here, without getting into too much of the numbers, the important point is 40% negative of 2020 did not repeat in 2021. And 2021 100% plus positive return is unlikely, nobody knows the future, but is unlikely to repeat in 2022. So you use the right word, pitfall. The pitfall is if you are investing in a goal-based manner, in 2020, you know that my goal is, let's say, 7 years away, 10 years away, 12 years away. You would not be prone to taking any knee-jerk actions. You would not be prone to take any emotional decisions based on the near-term movements of the market. Same thing would happen now also. Your 10-year away goal, 1 year later, today, it has become now 9-year away goal. Now, the maximum what you will do here, whenever market crashes or whenever market gives outsized returns, maximum what I recommend you do here is rebalancing of your existing asset allocation. During the equity market fall, if your intended equity investment breakup was 80-20, 80 equity and 20 debt, if the market goes down, obviously the debt component will remain as such or maybe slightly grow. Your asset allocation from 80-20 is likely to fall to suppose 60-40. You should have rebalanced it then during the crash phase, as well as if your asset allocation was intended 80-20, now because of the runaway in the market, it would be highly skewed towards in favor of equity. Again, you should do the same thing. Get back to 80-20, which is your intended asset allocation, and your journey would be much smoother, and you would not be taking decisions on the near-term market performance.
Okay, now let's talk about how you would define these goals. And I would think generally that you would define them, Amol, as per the duration in which you would hope to achieve them, right? So you would have short term, medium term, and long term. But for the purposes of those that are tuning in, that perhaps will want to sit down with a pen and paper and define these at a later stage, how do you define each of these?
Alex, while speaking with investors, hundreds of them, if not more, over last 19-20 years, I have realized that most common people like all of us, people like you and me, we typically have 3 or 4 or 5 financial goals. Now, of course, it will depend on the typical age bracket that we are at. So I'm taking a common financial goal for, a random kind of if you take 100 common people, most of them typically have following goals. So people typically say that I want to make a big purchase. It could be vehicle purchase, or let's, for the purpose of this discussion, let's take a purchase of a house or a home or a flat. Now, people who want to accumulate, we know very well that banks do not extend 100% of the property value as loan. You have to put down your equity. So 20 to 25, 25 to 30% is the kind of equity, is the kind of down payment that is required. So this is one of the very important goals that people have. I want to have my own home, my own flat 5 years later, and to make a down payment, I need to accumulate 20 lakh rupees, 50 lakh rupees for it. So that's number one. A subset of this goal is also, if you have already taken a goal, typically housing loan tenures are 15 years, 20 years, if not sometimes in some cases more as well. But nobody wants to service loans for 20 years. So typically if you have taken a loan 1 year, 2 year back, and if you have been doing good in your earnings, you have another second goal, which says that instead of 15 years, I want to close off. I want to prepay my home loan in, let's say, 5 years, 7 years. That's number two. Number three is child related or children related. People typically want to plan for higher education of children, higher education of their children. That currently costs a lot of money, including tuition fees, and also depending on whether you are going to study in which college and which part of the world. And last but not the least, and there have been numerous surveys, I think in our previous shows we have discussed this point. Indians, at such 78 to 80% of Indians have not planned for their retirement. Most of the times people feel that whatever, if you are working in an organized sector, most of the times people feel that the provident fund contribution and my PF corpus, my superannuation corpus will be sufficient. People really have no idea if my monthly expense currently is 45,000 rupees and I'm retiring 15 years later, how much today's 45,000 rupee expense 15 years later will be. And post-retirement, if I take my longevity to be 15, 20 years, how much of the corpus is required? People have really not paid. A lot of people have not done planning on those aspects. So these are, you mentioned how to identify those goals. Any financial event in your life that needs a bulk of money, that needs a chunk of money, is nothing but your financial goal. And how far that goal fulfillment is away. Retirement 20 years away, child education 12 years away, making a down payment for a home 3 years or 5 years away. This is how you arrive at these 2-3 numbers. You should start essentially by naming your financial goal, number one. Number two, you should also identify what is the existing sum of money that it will need. And of course, you have to factor in inflation so that you should know that based on inflation, how much that amount is going to grow into. And you have to plan for that amount. That's the second number. And third number is obviously the time. You need money 3 years later, 10 years later, 15 years later, so on and so forth. I think this is the right way of planning for your life goals, planning for your financial goals.
The last question, Amol, then has to do with asset allocation. And the question I think a lot of people contend with is that, do you allocate per goal or do you have an overall asset allocation for the portfolio?
Right. So very important question. Now let me take an example of retirement since we touched upon that point. Now I know several investors who are truly not familiar or not comfortable with equities. Many of the times these are our biases. These are some of the experiences that our near and dear ones have heard or faced. And we simply feel that, excuse me, we simply feel that equity is not for me. Now, it so happens there are n number of data points that confirm over decades, over study conducted over decades, that equity is the asset class which beats almost all other financial asset classes, almost all other asset classes over a long period of time. Now, if you completely are, excuse me, now if you are completely risk averse and you do not take any exposure to equity, you are likely to earn fixed income returns. And post-tax, not all the fixed income instruments have a exempt, meaning triple E tax exempt structure. Not all of them have that. So post-tax, your returns are somewhere going to be in line with inflation only. There is not really going to be any wealth creation. Now, this is what this happens for somebody who completely is risk averse. Now, if your goal is retirement, you are typically going to fall short unless you earn really well, unless your expenses are really low. This is not the case with most of the people, and you will really fall short. Now, let me take a practical example, something that has played out in front of our eyes over the last several years. EPFO, the body that manages provident fund money for all the salaried formal sector employees. Now, this body essentially used to invest in fixed income government securities instruments only. Over the last few years, EPFO corpus also gets invested into equity, initially via index funds. Now, because of that, we have seen that EPFO returns, EPFO is still able to maintain a much higher rate of return compared to what fixed deposits or even what PPF is currently at. So, to give that answer, whether asset allocation should be based on your risk profile or whether it should be based on the goal. If your goal is long enough, I would say 7 to 10 years or above, then I see no harm considering asset allocation towards that goal. I mean to say that even if you are completely risk averse, some element of equity for a goal that is 10 years or above, it will be helpful to your portfolio. And hence, if you have a long-term horizon, asset allocation also can be based on the which goal you are saving for, which goal you are planning for.
Understood. Now, this has been very useful, and I think it will help a lot of people when they're planning their asset allocation out as well. And I would encourage you, if you're watching this, to just sit down. If you're married, sit down with your significant other and list out the financial goals like Amol has just mentioned. Amol, do stay with us. We're going to take a short break on this program, but on the other side, we'll start taking a couple of queries that our viewers have sent in on email, and we're slipping to a short break. Viewers, do stay tuned. This is going to be useful to you. Back, you're watching The Money Show, and we've had a great conversation already. We've spoken about the basics of financial planning, and that relates to setting of financial goals. We've talked about how important those are. Now, we are going to take a few viewer queries. Some of you have written in. The first one that we're taking is SK Ataur Rahman's query. He points out that he is 34 years old. He says that he is unmarried. His monthly salary is 40,000 per month. And he's asking whether the following funds, and he's named a few, are okay to build up a retirement corpus that will be required starting 2047. That's quite a while into the future, and we're assuming, of course, that Mr. Rahman's monthly income is going to grow by a certain amount over the course of that intervening period. The funds that he has mentioned, Amol, are UTI Nifty Index Fund, which is 10,000 rupees per month. And apart from that, he's doing a post office time deposit of 3,000 rupees per month. His total corpus currently is as much as 10 lakh rupees. Is this the right approach, or should he add more?
Right. So, of course, he has mentioned his current income, but as of now, we do not know what his current expenses are. Now, in the previous part of the show, I mentioned during retirement, you will need the kind of, if you want to maintain your existing lifestyle, you will have to plan accordingly by taking into account your existing monthly expenses. We will come to that shortly. Speaking about the funds and the amounts, he's investing 10,000 rupees in a large cap index fund, Nifty index fund, and 3,000 rupees in a fixed income instrument, debt instrument. So I would say this is a very good approach. This is roughly 70-30 kind of an asset allocation into equity and debt. Some allocation into debt even for, and as you rightly said, that's quite a while. The financial goal is about 25-27 years away, starting from today. Despite of such an extremely long-term investment horizon, I would still say that he has taken a right approach by allocating around 25-30% to debt. Let me quickly touch upon the point why it is so. If we see sudden market flash crash like we saw in last year, which we have briefly referred to earlier in the earlier discussion, he will be able to allocate. If you do not have any surplus funds, how will you benefit from the equity market cash? You will benefit by doing the rebalancing. So debt component you can probably invest if you get an opportunity in the equity market. Now, by investing 10,000 and 3,000 rupees in a 70-30 fashion, I would say that he is likely to get a blended return kind of 10%. With existing lump sum of 10 lakh rupees and a 13,000 SIP for 25-27 years from now, I would say that he will be on track to achieve a corpus of about 3 crore rupees in this given time frame. And let me reiterate the CAGR once again. Because of the 30% debt component that is there in SIPs, in monthly investments, I have taken a 10% CAGR. You also touched upon a very important point that typically over the next 20 years, our viewer, his income is likely to grow. If it's salaried or self-employed, he's likely to have a higher surplus. If he keeps increasing his SIPs, currently 13,000 rupees a month, maybe 1.5 years later, 15,000, so on and so forth. If he goes by about 10-12, anywhere between 8 to 12%, then this corpus is likely to go up by another 40 to 50%. So either a 3 crore rupees or 4.5 crore rupees corpus can be accumulated over next 25-26 years by doing this, sticking to this method. One quick last point. Since you have such an extremely long-term investment horizon, I would suggest, in addition to the Nifty 50 fund, you can probably try to look at Nifty 500 fund as well. The reason is Nifty 500 fund has about 20-25% exposure to mid caps and small caps. So you will get some upside because of the mid cap and small cap exposure that Nifty 500 will get for you.
And considering that this is a very long-term goal. All right, Amol, do stay with us. We're slipping into one more short break, and then we have another viewer query, which I think should be also very interesting and will be, I think, useful to a lot of viewers tuning in. Do stay tuned. All right, welcome back. Now, this next question is from Rohan Belani. I say this is interesting because he's of the age where Amol, he pretty much has the canvas open for him, and he can change things as in how he sees fit. He's 27 years old. He's currently investing 12,500 rupees per month in mutual funds via SIPs. He says that his risk profile is low, and he's wondering whether the funds that he's identified and that he's investing in are the right choice. He also says that he can invest an additional 5,000 rupees, and he's wondering whether to divide it into the funds that he has mentioned or whether to put it in something else entirely. So he's got the Mirai Asset Emerging Blue Chip Fund, which is putting 5,000 rupees into. He's got Axis Midcap 5,000 rupees, and he's got IDFC Sterling Value Fund of 2,500 rupees. We're not really certain what his long-term plans are, but assuming that he is investing for the purposes of retirement, then what should his approach be?
Right. So this is, as you rightly said, this is a very interesting question. If I heard you right, Alex, Rohan says that his risk appetite is low. Now let's take a recap of the funds that he is investing into. The first, Mirai Asset Emerging Blue Chip, is a large and mid cap fund. Second one, Axis Mid Cap, as the name suggests, it's a mid cap fund. And the third one, IDFC Sterling Value Fund, is essentially a value fund as of now. I think that fund is positioned equally across the entire spectrum of market cap, roughly 30-35% into large caps, mid caps, and small caps. We know very well that value is a theme that may play out over a long term. Fund manager essentially tries to identify sectors and stocks where he sees the value, and based on that, when the market realizes the true potential of that share, that company, you get richly paid for the same. Why I'm saying all of this is because Rohan says that his risk appetite is low. If your risk appetite is low, large and mid cap fund or an out and out mid cap fund or a value fund are not the spectrum or not the kind of categories of funds which you will venture into. You also mentioned, Alex, that we are not sure about what his investment horizon is. Let's assume that it's retirement, like you said. So essentially 20-30 years kind of time frame he has. If this is so, then despite of having low risk appetite, I would say he should still, like we discussed in the previous part of the show, he should still have some some allocation towards equity. What I would suggest is existing funds. If I'm not sure you have been investing over last what period, but if you have invested over last couple of years, your investment experience returns, portfolio returns are currently very good. I would suggest the additional 5,000 rupees that you are planning to invest. Normally, 3 schemes are 12,000-15,000 rupees of SIP amount. Normally, I would have asked you to top up into these schemes alone. But since your risk appetite is low, I would suggest you to look at something called as Balanced Advantage Fund. Balanced Advantage Fund is one of the categories of hybrid fund where you have asset allocation towards debt as well as equity, and it is dynamically managed based on valuation parameter and various other parameters that a fund house or a fund manager manages the scheme in line with. So I would say please continue. If you have long-term investment horizon of 10 years or above, additional 5,000 rupees, let it go to a hybrid scheme like a Balanced Advantage. And since we have been speaking about scheme names over here, I would recommend you to look at ICICI Prudential Balanced Advantage Fund. But if your investment horizon is anything less than 3 years or 5 years, then these schemes, the 3 schemes that you mentioned, do not, or these schemes are not suitable for you. I would suggest you to take an approach of about, for a 3 to 5 years kind of an investment horizon, I would suggest about 40% equity and remaining 60% debt. But there are few questions, few details that are currently unknown or unanswered. I would suggest you to seek help, Rohan, so that you benefit from the same. But long-term investment horizon, these schemes are fine. And please add 5,000 worth of Balanced Advantage scheme.
All right, Amol, and that brings us to the end of this particular query. Thank you so much for spending the time. In fact, it's been an insightful chat as always, and I look forward to speaking to you again in the near future.